Hi, I'm Patu from freefincal, and let's talk about what is our investing risk appetite. Do we know what our risk appetite is? Before we begin, I've just published the August 2019 Nifty 100 low volatility and momentum stock screener. You can get it from this link. So coming back to risk appetite, some people say I have high risk appetite, I have moderate risk appetite, or medium risk appetite. I have no idea what that means. How do you define what is the difference between high risk appetite and uh, medium or moderate risk appetite? The only thing I know is people who say I have low risk appetite. I understand that they have no risk appetite. That is, they cannot take any kind of risk, and they are very clear. They cannot stomach losses. But when you say high risk appetite, how much loss can you stomach? Also, I don't know. I mean, I have been investing now for what, 10 years. I don't know what my risk appetite is. I don't know. I don't know how I will react when there is a big crash. I honestly don't know. That's a fact of the matter. The good news is I don't need to know. The only thing I need to know is what is the risk that I need to take. I don't need to know how much risk I can handle. I only need to know what is the risk I need to take, or rather, what is the risk profile of my financial need. And the whole idea is to try and align our investing strategy to that. So that is where you need to have a proper financial goal, have a proper target. The idea is very simple. Now, suppose that's my target corpus, right? I start investing here. So the idea is to slowly go to and reach the target corpus. Of course, I can have small fluctuations. That's all fine. I don't want to have huge fluctuations like this while to try and reach there. That is what I need to construct. I need to construct a portfolio and an investing document. Basically, I'm going to say I'm going to invest here, here, here. I'm going to rebalance every 6 months, every 1 year, whatever. I need to write that down and implement it so that I reach the target corpus comfortably. That is the risk that the goal needs. That is all. My own risk. See, there are different kinds of people. Sometimes they will say, I have seen people say, I am going to invest all my money in equity for the first 10 years or the first 5 years of my investing journey. Then I will shift to debt. Why? Because they assume that that will maximize the returns. That's not true at all. So that is like the risk you need to take is here, and the risk you are saying you will take is there. That's very high, and that's wrong. And in many cases, the risk people need to take is here, and the people, they would have not taken any kind of risk so far. Most of the money would be lying in FDs, most of the money would be in safe instruments, and they need to change the asset allocation so that they increase the risk in the portfolio because it's necessary. So it is this realignment that is necessary. So that is the reason why I tell people, don't don't start assuming that you can handle this much risk, you can handle that much risk, or I can only handle this much risk, and so on. That is not the correct approach. First of all, nobody knows how much risk they can handle. We can find out is how much risk we should handle. Whether we handle it or not is a different matter. That we cannot say in advance. But at least I can quantitatively find out this is my particular financial need and this is the risk I need to take. This is where financial advisors use something called risk profiling. They provide the client with a set of questions, and the client has to enter the answers. They will be typically objective type, and therefore they will find out what is the client's risk appetite, and they will try to match that risk appetite with the risk profile of the financial goal. So that matching is what a financial advisor should do. How well they do it tells you how competent they are. That's one way to do it. But the problem with these risk profiling software is they're all objective type as far as I know. And the problem is when I ask an objective type question, it produces a certain bias. For example, I ask, how much return can I get from equity over 10 years or 25 years? I then give options. Option A, 12%, option B, 15%, 18%, 10%, and so on. Now the problem is my mind, I get locked onto those numbers and then I have to choose. Suppose I ask the same question without any without any options offered to them, they will give you the answer. They will tell you what they really want to, what they expect from equity, and the financial advisor can gauge which is the right answer, which is the wrong answer, which is average, above average in terms of return expectations and so on. So instead of finding the, whether it's an advisor or the investor, instead of finding risk appetite, or rather how much risk I can take, which is of no use in my opinion or cannot be determined really in my opinion, what we need to find out is the risk quotient. That is just like IQ, we need an RQ. We need to find out how much we as an investor or as an advisor, the client knows about risk, understands about risk. We find out the risk quotient of the person, then we align that, which we educate them, tell them you're wrong here, you're right here, you need to take more risk, you need to take less risk, you need to temper down your expectations, and because this is what you need to do, and you are somewhere off, either up or down, and that's essentially the whole idea. So this is the reason why I keep talking about risk, and I have been it has been one of my goals to try and build a risk profiling tool. But then I realized that the simplest way to provide a risk profiling tool is to have a list of questions without any options given. Let the person or the client, potential client, enter answers, and then the financial advisor or the expert, or you can do a self-analysis, find out from a grid where the answer fits in, and from there evaluate risk quotient, and then help the client understand what is the risk necessary to take, and not worry about how much risk that they can take. How much risk you can take or I can take is immaterial, it is useless, because that information is most likely based on what we read and what not, what we have experienced. Even for people who have experienced a 2008 crash, they cannot claim I have experienced 2008, so I have high risk appetite. That is not true at all. 2008 was what, 11 years ago now, almost. So at that time you had 11 years more for your investing, in your investing journey. That time the risk you could take was much higher in in terms of the financial need. That risk could have, the risk profile of the goal was different from what it is today. I've been saying this, for example, for my son's education. I started investing before he was born, but today he's 10. Those 10 years have gone. Yeah, in 8 years he will start college. So I can't say I can take the same amount of risk that I did 10 years ago. So things keep changing. So I'm planning this tool, or this, well, it's not a tool, it's just a set of questions with answer grids and so on. Let me see how this comes out, but I would like you to think deeply about what is the risk necessary for your financial goals. You can do that by introspection, or if you want help, you can use my robo advisory tool, or you can consult a SEBI registered investment advisor who is a fee-only financial planner, and come to these, make some decisions, have an investment strategy. So please go ahead and give some thought. Let me know what you think about all this. I'll catch you in another video.